Hi, I'm John Napolitano, the CEO of U.S. Wealth Management in Braintree, Massachusetts. When starting a business, the actual business structure needs to be carefully considered before you launch yourself into the marketplace. What I mean by structure is the type of entity that you choose. You can be a sole proprietor, a corporation, limited liability company, or a partnership. For a partnership, you'll need a partner. All the other structures, though, will allow for a single owner. Now, in many cases, the sole proprietorship may be the least desirable. In a sole proprietorship, you personally are the owner of the business's assets and liabilities. Should that business fail, you'll be held personally liable for the debts of that business. The main advantage of a sole proprietorship is simplicity. You file a Schedule C with your personal tax return, register your business with the town in which you operate, check on the name that you've chosen to make sure that no one else is using it, and off you go. Jumping into partnerships, we see attributes similar to those of a sole proprietorship in terms of personal liability, except here, you're exposed not only to the actions of yourself, but to your partner as well, in theory, doubling your personal liability exposure. In a partnership, you should have a legal agreement with your partner, called a partnership agreement. This agreement would establish certain operating provisions, such as the roles of each partner, who has the authority to borrow, and also contains provisions regarding things like capital contributions, salaries, and each partner's share of the gains or losses. A partnership files its own tax return, a Form 1065, and each of the partners will receive a K-1, and this is the form that tells you what to report on your personal tax return. Partnerships can be somewhat complicated, and shortcuts with the agreement or not addressing issues such as disproportionate capital contributions can cause tremendous strain on the business relationship between the partners. Corporations and LLCs are probably the most common structures that are used to start new businesses. Now, these entities are fairly simple to establish, but they'll also require certain corporate governance standards be met, even if you're the only shareholder. Some of these include things like an annual shareholders meeting, minutes of that meeting, even if it's just a meeting with yourself, the appointment of at least one other corporate officer other than you, and annual state filings. If your new company has more than one owner, just like a partnership, you should have a legal agreement that sets out all the provisions for death, disability, and other problematic issues that you may find and address in a partnership agreement.